This podcast is produced by the Capabuild Foundation. The views and opinions expressed herein are those of the hosts and their guests and do not necessarily reflect those held by Capabuild.
Global tax rules are designed far from where their impacts are felt the most. My name is Atiya Waris. Join me and my co-presenters as we explore where global tax perspectives meet local realities in the Global South.
It's a pleasure to have you on our podcast today. So let's start by you telling us a little bit about yourself.
Sure. Well, it's a pleasure to join you. My name is Jan Joost Bruinsma. I am a Dutch certified public accountant, and I also hold a master's degree in tax law. And I lead the global tax accounting and compliance at Signify. Signify is a Dutch multinational, and people might recognize us from the former Philips Lighting. So we became a separate company in 2016, where we separated from Philips and got a listing on the Dutch stock markets. And today we are widely recognized as the global leader in lighting. So at Signify, we operate in more than 70 countries with a legal presence. So that's either through a legal entity or a permanent establishment, which, as you can imagine, comes with quite a bit of tax complexity and compliance.
But that's fascinating. And actually, that's why you're here with us today, to have a conversation about this international tax framework and what it's looking like. And it does look like you're doing a lot of filing. So just as a matter of interest, how big is your team at Signify?
So our team is roughly 35 to 40 people. So we do not have people in all the countries where we operate. Sometimes we rely on a third-party advisor, or sometimes it is, let's say, someone with a more broader finance profile that assists us with the compliance. I think in 10 countries, more or less, we have actually tax people, internal tax people within Signify.
Thank you very much. So today's conversation is really about Pillar 2, which you've alluded to a little bit already. And for those who are not familiar with the global tax reform process, could you explain what Pillar 2 is about and why it has sparked so much debate about fairness and complexity, especially amongst developing countries?
Yeah, good question. Pillar 2 is essentially the global minimum tax. It is designed to ensure that large multinationals, so those with revenues, well, consolidated revenues in excess of 750 million, pay at least a 15% tax in every jurisdiction where they operate. And the idea is that should reduce profit shifting to jurisdictions with a very low tax rate, and it should also put a floor or reduce tax competition between jurisdictions. The logic is that if companies can no longer route profits to very low tax countries without consequences, governments should be better able to protect their local tax base. That sounds straightforward, but in practice it is quite different. It's highly complex, Pillar 2. It introduces, I think you can say, a completely new system, separate from the financial accounting rules, but also separate from the local tax rules, with detailed adjustments. For instance, in relation to how do you account for stock-based compensation payments, or how do you treat foreign exchange results or amortization of intangible assets, along with substance-based carve-outs, safe harbors, extensive filing requirements, notification requirements. So I think it's fair to say that even supporters are finding this quite demanding. So the OECD has also continued to issue guidance, most recently early 26, with an extension of safe harbors, with a permanent safe harbor, and also with a sort of side-by-side regime. Probably we will get to that at a later point. But in short, that means that if there is a parent entity, ultimate parent entity, in a qualifying side-by-side regime, additional top-up taxes under Pillar 2 might not be applicable. And then to answer your question, so specifically for developing countries, I think it's not so much about whether tax avoidance is an issue. I mean, I think everyone is on the same page there that it is. But the question is more whether Pillar 2 is designed or built in such a way that it allows the developing countries to really benefit from it. I mean, they most of the times have limited administrative resources or capacity, or are still in the, let's say, more developing stage when it comes to setting up tax systems. And I think the risk is really that Pillar 2 is an additional complexity which is for them hard to manage, and it becomes something that they must comply with instead of really securing any additional revenues.
I like that means compliance is taking priority over even generating income. So from your personal experience, what is this gap between global ambition that the OECD is trying to roll out, of course, and also now the UN is looking at, the IMF has it in their debt agreements. What does this look like with the on-the-ground capacity that you see?
Yeah, I think that is probably the key question indeed. So yeah, the Pillar 2 system might sound fair on paper, but the question is really, how do you implement it? And is it implemented in a way where it is simple? Also, not per se a simple system, but simple to execute when it comes to the administrative burden, especially for the local developing countries. I think the developing countries might have the idea that they're going to, benefit from this in terms of revenue initially when it was announced. But now when they are actually moving into the implementation, they see that more the stronger nations, the more powerful nations have basically more power, or they benefit from treaties which were established in the past. And then I think that's where it really becomes uncertain for them. So do they then really want to invest in building such a new structure, training all the local tax inspectors, versus an uncertain payoff in terms of additional revenues? Does that answer your question a bit?
Absolutely, it does. That also takes me to then, so is there a simpler and more practical system that could offer a better path for developing nations to strengthen their revenues? Is there something historical, for example, in the wealthier nations that they applied maybe a lot earlier that could be considered in these developing countries? And I'm particularly struck about the fact that most least developing countries, for example, are not part of the OECD process at all. And so, the poorest of the poor are still really out of the system.
Right.
So do you have suggestions?
Yeah, for sure. In theory, Pillar 2 could help, right? Because it helps in limiting profit shifting, and especially with the introduction of the qualified domestic minimum top-up tax, it should also allow countries to collect the top-up tax locally rather than losing it. So that is an important measure when it comes to protecting the local space. So I think that's really an important item. And then when it comes to making the system more simple, there I think you basically need to start with what's already there. I, for instance, find it a bit a pity that we did not really start from the perspective of the consolidated financial statements and left it there, because that's basically your starting point to allocate the pie. And if that is done on a consistent basis across all jurisdictions, and you limit the capacity of other countries to introduce all kind of adjustments that might sound fair on paper but are really complex, you probably will not reach your goal. So I think it would help developing countries if it is a more simple system based on really the accounting setup, where you allocate the profit to countries based on substance-based factors, and then you leave it in the hands of the local country to tax it. And then, because I think the additional uncertainty that you have today, that comes from the complexity of the rules themselves, but it also comes from the complexity of additional rules that are being issued.
Yes, no, that is certainly very interesting. But I also think that, some major economies have also not fully adopted Pillar 2. And I find that quite fascinating, because you have the negotiating states, and most states are in the room for negotiations. But then when it comes to your contracting states, or the ones that implement, suddenly the ones that were in the room that have often watered down the entire process are not even there. And then the result is leaving a huge compliance burden on only specific countries. So from an equity perspective, even within the group of wealthy nations, there is clearly a line up? The more wealthy, the less wealthy, the contracting who are negotiating, the contracting states that never negotiated, right? So how does this affect fairness when certain countries or companies are doing this operation with the different rules that you've just mentioned?
Yeah, again, a great question, Tia. I would say it weakens trust very quickly. So any tax agreement, a global international tax agreement, should not just depend on, let's say, the rules itself, but also on understanding that all countries, major countries, are moving in the same way. And at the moment, that's not there for Pillar 2. So there are larger jurisdictions. I already mentioned China, but India as well. They've not implemented Pillar 2, while others are moving ahead and are implementing and dealing with the compliance burden.
How does the complexity of Pillar 2, right, challenge those basic conditions? And when different countries are following these different versions of the rules, because now we're not even looking at who's implementing and not implementing, but how they're implemented. Do you find yourself bumping up against different interpretations of Pillar 2 related issues? What does that look like, and how fair or consistent then is this impact on investment globally?
Yeah, again, very good questions. I think, complexity and stability are not necessarily opposites, but most of the times in practice they feel like that. So the OECD, of course, has tried to standardize the Pillar 2 structure or framework through model rules, administrative guidances that they've issued a couple of times, and safe harbors. But even with that structure in place, I would say it's still very complex, and in some cases also not fully aligned with traditional tax principles, such as the avoidance of double taxation. You see that in examples like the recapture rule for deferred tax liabilities or the treatment of tax credits, where Pillar 2 can really lead to double taxation. And then at the same time, we at Signify, we are dealing with a landscape where national rules come into force at different times, and sometimes also at different moments, even within the EU. So we're not really applying one system. No, we are, in our situation, applying many systems across all the countries that have implemented Pillar 2. So there's a significant administrative burden. If you operate in, say, 70 plus countries like we do, and a large share of these have implemented Pillar 2, you need to register locally, you need to make notifications locally, you need to submit local QDMTT returns, even if you apply for safe harbors. Yeah, I can tell you from a business perspective that creates not only an administrative burden, but it also creates uncertainty, many levels. So which rules do you apply? How do you calculate them? Incentives that might be relevant today might no longer be tomorrow if there's a top-up tax elsewhere. I already gave you the example in Africa, which is for us really a concrete example, actually. And then, for businesses deciding where to locate the activities, that uncertainty becomes really a cost. Yeah.
So if a developing country is trying to figure their way through this process, right? And you can imagine that there's, of course, still also the UN system, there's a UN tax treaty going on. How should a developing country strike a balance between not only aligning with the global standards, implementing their own domestic laws, but also making sure that they create a clear and a transparent environment to encourage local and foreign investment? Because, of course, that is one of the biggest challenges facing many of the developing countries. What should it prioritize?
Yeah, I would say it should start with simplicity and consistency. I think those are really important also to attract investments. And by that I also mean, the rules, they need to be administered across jurisdictions without or within a developing country, without having to rely too much on specialists. Because reality is they are scarce. You don't even have them in some of the jurisdictions. So I think that's really important. A system might look simple or elegant on paper, but it could still be unfair in practice. That's manageable perhaps for some administrations, the more mature administrations. But I already told you, I think in the Netherlands, we are struggling as well. So then the question is really, in the current form, is it workable for developing countries? To me, a fairer system would be more simple, more focused on source country tax rights, easier to administer, and it should also be more transparent about the trade-offs to the developing countries. So protect the source tax base, but also be transparent about the benefits. Because I think, initially the local developing countries might have had the idea that Pillar 2 would be this big new revenue stream that would be there, but then they realized, whoa, this is complex. We need to invest in additional tooling, people, etc. Might not be the way forward. A simpler system could also be, focus on the minimum, if it's about Pillar 2 then, on a minimum tax based on your consolidated financial statements. It's more really a simple calculation. Or look at Pillar 1, because Pillar 1 is also meant to sort of reallocate taxing rights. And I know Pillar 1 is also not really alive nowadays, but that is actually meant to sort of reallocate the huge income streams that are made by these tech companies, also in the developing countries, where the income is actually made, right? Or where the users sit. So I think that discussion needs to be reopened again, if that makes sense.
Yes, absolutely. We've talked a lot about trust and transparency, and Capabuild works to connect businesses and tax, and it's how we know you, right? Of course, and to try to share the knowledge and find practical solutions. And I think we've started to touch on some of them. So this healthy skepticism, when we don't always agree with each other, I think is really important. What's it going to take? Because you've alluded to simplicity, you've alluded to a little bit more transparency, I think, but there's also questions of trust. So if we're looking ahead and we really want to create this, equitable space for all member states in the world, right? And you mentioned the consolidated accounts. I think that's a really interesting approach as well. But what do you think would be the thread we could pull at to sort of help strengthen revenue collection without having them be overwhelmed with the rules and have no influence or little influence in shaping it?
Again, a very good question. Yeah, I think Capabuild is also a great example, because it starts with the people, right? The local tax people that we are dealing with as well at Signify. If they are really more mature, understanding all the principles, for us it becomes easier to invest there and to have a business presence there. And so I think that's really a great example by itself already. When it comes to Pillar 2, again, I think simplicity is the most important thing for me, because Pillar 2 is international tax. It should be administrated across all the jurisdictions without the reliance on specialists. I think that's very important. And indeed, I have my ideas about that, but I would really start with that consolidated reporting that companies already have there, that can be used to allocate income. And then that helps, right, to secure the tax base. But then what's also important, I would say, you leave the actual taxation in the hands of the countries where the activities take place. So the consolidated set of financials you use to allocate the pie, but then it's up to the developing country. Because if a developing country chooses to apply a lower tax rate for real substance-based investments, for instance, that should not be neutralized by a top-up tax elsewhere. That's really about protecting the source country tax rights. And of course there are safe harbors. But I mean, it's better, I would say, to kill the whole issue than to introduce a safe harbor to mitigate it a bit. A second priority to me would be, and I think you already touched upon that, Tia, that's about participation, right? So it's not enough to involve the countries after the design is out there. I mean, they need to be part of the development phase, part of setting the agenda and defining also what's administrative feasible for them. I also think, policy space for them is important. So that's also again about targeting incentives and attracting investment, because you cannot remove that space or that the leverage that they have. I mean, developing countries then. And then also I think there's a role probably for the more developed countries, which is to support developing countries through, bodies, maybe the OECD, but maybe like a separate body where you help them with the implementation, with the coordination, and really put a simple place in practice. And then I think if you combine all these elements, then probably developing countries are also seeing that the system works, right? It works for them. It works in terms of generating additional revenues or stopping the profit shifting. Then you're probably there. That's a long way ahead.
I love that. To me, that just sounds like it's very valid that there's a tax negotiation place at the UN because they feel included. They have the policy space, even if they're not physically present in the room. It's one concern I do have. There's not enough LDCs in the room also at the UN right now in the negotiations. So participation then becomes important. And then they'll sign on if they agree on it. I don't know if there will ever be a global rollout because, of course, member states will continue to maintain their sovereignty. That's always going to be there. But I want to thank you for what has been a fascinating conversation. I feel like we need to have this coffee chat again later because I have loads more questions. For now, I just want to know if there's anything else you want to share before we bring it to a close.
No, I think it was a wonderful conversation. So thank you very much, Atiyah. Yeah. Lovely talking to you.
It's our pleasure.
Join us for the next episode with Katie Jakma and Lisbeth de Grootmeijer. Both work for PwC the Netherlands and both are outstanding tax experts in the international arena. One has a background in tax policy, the other one is an international tax lawyer. They both grapple with the many different aspects of Pillar 2 and have very clear views where they see the future ought to go or will go in regard to the international global tax developments. Stay with us. Here are some of the things they had to say.